At 2:47 a.m. Beijing time, something seismic landed in the inboxes of China's top exporters. The message was short, sharp, and effective immediately. No more transactions in US dollars. By sunrise, global markets were in chaos. Bond yields were spiking, Wall Street was stumbling, and trading floors from London to Tokyo were rattled. One quiet directive, no press conference, no tweet, no threat. Just a silent surgical strike. Now, one question echoes across the financial world. Is this how the dollar's reign ends? Not with a bang, but with silence. Strategic, deliberate, and unmistakable. In April 2025, China's Ministry of Commerce quietly issued a sweeping order. Over 400 state-owned and private firms were to stop settling new trade deals in US dollars. A leaked memo, later confirmed by the South China Morning Post, made one thing clear. This wasn't a request. It was mandatory. It wasn't routine accounting. It was a policy earthquake. Within 72 hours, Bloomberg reported a staggering 12.4% drop in China's dollar-based trade settlements. Analysts at ING called it Beijing's boldest move yet to institutionalize de-dollarization. But this shift wasn't just about currency. It was about power. Backed by data from SWIFT, the yuan's share in global trade finance surged from 4.5% in mid-2023 to 7.6% by March 2025. This wasn't organic. It was engineered. And with China now using its digital yuan to power bilateral energy deals, the message is clear. China isn't just diversifying, it's rewriting the rules. The impact on the US financial system was swift and brutal. Within 48 hours, US Treasury yields jumped. The 10-year note soared 38 basis points to 5.09%, a level not seen since before the 2008 crisis. JP Morgan reported that more than $212 billion in US Treasuries were dumped in just 4 trading days, primarily by sovereign wealth funds and Asian investors. The People's Bank of China had already been pulling back, cutting its US debt holdings from $859 billion in January to $729 billion by March, according to US Treasury data. This wasn't a pivot. It was an acceleration. This is more than a financial move. It's a declaration. And for investors, policymakers, and everyday citizens alike, the message is sobering. The era of unquestioned dollar dominance is no longer a given. Now, the world watches and waits to see what comes next. Mohammed El-Arian, chief economic advisor at Allianz, issued a stark warning on CNBC. This shift could permanently reset global borrowing costs. But this isn't just about markets. It's about power. Is China's quiet strategy the beginning of the end for the dollar's dominance? The US bond market has just entered turbulence not seen since the pandemic crash of March 2020. But this wasn't a random shock. It was a message. Calculated, clear. Weaponize the dollar, and Beijing will start treating it like a liability. And if US Treasuries are no longer the safest asset on Earth, then what is? The dollar's grip on the global economy hasn't collapsed overnight. It's been eroding, quietly, steadily, for over a decade. According to the IMF, global central bank reserves held in US dollars have fallen to 57.2% in Q1 2025, down from 71% in 2000. Now, with the world's second-largest economy cutting dollar settlements, that long drift may have just turned into a tipping point. And it's not just China. Eswar Prasad, former IMF official, told the Wall Street Journal we're witnessing a deliberate decoupling, not just by BRICS nations, but even by some G7 allies. In March, the yuan's share of cross-border settlements surged to 48%, overtaking the dollar for the first time in China's trade history. Then came a symbolic moment. On April 18th, Saudi Aramco completed its first full oil shipment to India, settled in yuan, as reported by Reuters. This is how a reserve currency loses its crown. Not with a dramatic collapse, but one quiet transaction at a time. So what's replacing SWIFT? And why should Washington be worried? Let's take a step back. This wasn't panic. It was precision. If this is just China's opening move, what does checkmate look like? SWIFT currently moves over $5 trillion a day across 11,000 institutions, but it runs on decades-old infrastructure. Enter MB-Ridge, a new digital payment network co-developed by China, the UAE, Thailand, and the BIS Innovation Hub. In March, BRICS processed $23 million in cross-border trades, near instant, fully traceable, and crucially, beyond the reach of U.S. oversight. This isn't just a technological upgrade, it's a geopolitical chessboard, and China just moved a major piece. Anup Nandra, HSBC Asia's chief of digital infrastructure, told Bloomberg that BRICS proves something critical. Real-time, dollar-free settlements between sovereign currencies are no longer theoretical. They're happening, right now. While the U.S. is still debating the future of digital currencies, China's digital Yuan is already processing over $250 billion annually in domestic and cross-border transactions, according to April 2025 data from the People's Bank of China. This isn't a pilot, it's live, and it's thriving. As Beijing quietly constructs a new financial backbone, political pressure is mounting in Washington. On April 19th, President Trump took to Truth Social with a blunt message: "Cut rates now or we risk total collapse." The impact was immediate. Within hours, the Fed came under fire. But a forced rate cut isn't a solution. It's a pressure valve. And when the global financial order is in flux, every move carries weight. The dollar responded violently. The dollar index plunged from 104.3 to 98.7 in just 5 days, the sharpest weekly drop since 2009. According to Goldman Sachs, capital outflows topped $76 billion in the third week of April alone, driven by sovereign sell-offs and corporate hedging. Here's the real concern. Lower interest rates might juice short-term lending, but they're also undermining long-term faith in the dollar. In a Financial Times op-ed, Mohammed Al-Arian warned that artificially weakening the dollar could trigger a shift toward non-dollar assets like gold or yuan-based commodities. That shift is already visible. For the first time in 4 decades, the dollar lost value simultaneously against the yuan, yen, and ruble. So as Washington's fiscal engine runs hot and Beijing quietly rewires the global financial grid, who's really steering the system? According to the Lowy Institute's Global Diplomacy Index and IMF trade data, by Q1 2025, 128 countries now trade more with China than with the U.S. That list includes longtime American allies like Germany, South Korea, Australia, the UAE, and Chile. The numbers are staggering. Per U.S. Census Bureau data, China's export volume jumped 8.9% year-over-year in Q1 2025, while U.S. exports shrank 3.2%. But it's not just about scale, it's about speed. As Bloomberg notes, China's edge lies in velocity. Beijing is aggressively locking in bilateral free trade deals across Asia, Latin America, and the African Continental Free Trade Area. In this new global race, China isn't just gaining ground, it's redrawing the map. The U.S. hasn't signed a major trade deal since the USMCA in 2020, and the economic landscape is shifting fast. As economic historian Adam Tuss notes in Foreign Policy, trade is no longer just about economics, it's about strategic alignment. And increasingly, nations are tilting east. But what happens when capital flows reverse? The U.S. economy shrank by 0.7% in Q1 2025, marking 2 consecutive quarters of contraction, per the Commerce Department. Beneath the surface, the cracks are deepening. Real wages fell 2.1% year-over-year. Credit card defaults hit 3.6%, the highest since 2011, Experian. Small business bankruptcies surged 18% in April, Wall Street Journal. Mortgage delinquencies spiked 12% month-over-month, with Freddie Mac warning of potential systemic stress in its April 17th risk memo. Morgan Stanley. Economists now estimate a 40% chance of a technical depression by year-end, not just defined by GDP decline, but by sustained multi-sector deterioration. The Fed is trapped. Raise rates, and housing collapses. Cut them, and the dollar weakens. Meanwhile, the ISM Manufacturing Index plummeted to 44.7 in April, its lowest since the early pandemic, signaling severe contraction. U.S. export orders dropped 9.3% quarter-over-quarter, and West Coast port imports, a critical gauge of global trade, plunged 27% year-over-year. According to the Port of Los Angeles and the American Association of Exporters, Nearly 20% of major U.S. manufacturers have lost access to key Chinese suppliers due to Beijing's capital restrictions. Even Boeing, once America's top exporter, suffered 14.2 Bs in order cancellations in Q1 2025, more than double its Q4 2024 losses. Reuters. The question now isn't just about economics. It's about what happens when monetary policy becomes a geopolitical weapon. Trade credit insurers like Euler Hermes are slashing U.S. exposure limits, warning of volatile, non-payment risks. When the arteries of global trade seize up, leadership alone can't unclog them. But the real question isn't just about Beijing. It's whether Washington is accelerating the dollar's decline. The U.S. government's fiscal recklessness is eroding the dollar's foundations. In just the first 4 months of 2025, the federal deficit ballooned past $1.3 trillion, driven by surging entitlement costs and emergency monetary measures, Congressional Budget Office. At the same time, foreign demand for U.S. debt is collapsing. Foreign central banks now hold just 38.6% of Treasury issuance, down from 44.9% in 2019, Treasury International Capital Report. Japan and Belgium slashed their holdings by 11% and 14% respectively in Q1 alone. Saudi Arabia's treasury reserves hit a 9-year low. As Mohammed El Arian told Bloomberg Surveillance, confidence isn't lost overnight. It's eroded by erratic fiscal management and weaponized economic policies. The U.S. didn't just wake up to fewer treasury buyers, it pushed them away. So the real issue isn't whether the dollar is under attack, it's whether America is sabotaging itself. If China is methodically cutting the dollar's lifelines while the U.S. frays them from within, who's really shaping the future of global finance? As the UN gains influence, treasuries lose prestige, and U.S. policies accelerate capital flight, the next domino won't be a trade deal or currency swap. It could be a seismic shift in the global reserve system. And the fallout won't just hit Wall Street. It'll rip through pensions, paychecks, and prices in every American household. But here's what no one's asking. What if this isn't the final blow, but the setup for something far bigger? So ask yourself, is the world preparing for a post-dollar era? Or is the US writing its own financial obituary? Thanks for watching. If you found this breakdown eye-opening, don't forget to hit like, subscribe, and turn on notifications so you never miss an update. Want to dive deeper? Check out another video on your screen right now. See you in the next one.